Hi, this is Liqian Ren, Director of Modern Alpha Wisdom Tree ETFs. Welcome to China of Tomorrow podcast series, where we navigate China, India, Japan, and the broader emerging markets with members of Wisdom Tree and other industry leaders. This is Liqian. Today is September 30th, 2024. A very interesting past week on China. And China currently is in a retail-driven rally, the market. And I'll quickly recap what happened and what it means for investors. So essentially what happened is that on Tuesday, 24th, the local time, then before the market opens, the PBOC had and the CSRC had, which is the SEC equivalent, and then the Financial Bureau, which is it doesn't really have a it's more like a banking and insurance company head regulator. So if you think about it, these three are the kind of top three administrators for China's financial industry. They have a press conference and announced a lot of stimulus policies. But the interesting thing is that the actual stimulus they have announced, such as cutting off reserve ratio, cutting off mortgage rate about 50 basis points, a cut off the base rate about 20 basis points, further removing of housing restrictions where the people can buy houses in bigger cities like Shanghai and Beijing. Most of these packages were kind of leaked before the meeting. There were a lot of so-called little paragraphs, unsourced stuff floating on social media, and a lot of these were mentioned. And when these three big heads of China were talking about these policies, actually the market was positive, but didn't really go much up. It's close to like 1% positive. But then in the middle of the trading, the PBOC governor Han Gongsheng, he mentioned that the PBOC will start 2 channels to provide liquidity specifically for the stock market. So, many people were thinking about stimulus for the physical policy or the money profit for the real economy. Nobody, myself included, I definitely did not see this specific thing coming, and because it's a completely new mechanism. So essentially, PBOC is going to give money, loans, low interest loans to companies so that they could go and buy stocks for purchase, for stock share purchase. And they are also going to be willing to take collateral from brokerage firms, insurances, and that so that they could go out, use those money specifically for stock market. So essentially, it's a direct support for the capital market. And then the market, went up, just ripping higher Tuesday, Wednesday, Thursday, and Friday, and then local time Monday. In the next week, though, China local market, China A-shares is on a national week holiday off. So actually, there is not going to be trading. It's for the 75th founding of People's Republic of China. The Hong Kong market will be open most of the time. It will be closed on October 1st, which was a national day, but it will be open. And then, now the market is up 20-30%. And in China, for the local market, you can actually see the big order, the mid-size order, and the small order. So you can see actually the bigger chunk orders was on the selling mode, but the small investors are jumping in because suddenly you have 20-30 some single stocks up 50% rally, and China was you have retail investors. I think it's not completely a GameStop kind of sentiment, but you have retail investors jumping in to make money. So these kind of rallies, it's very, very difficult for for long-term investors to catch, unless you have a really good macro trader, and the time it takes is going to be very, I wouldn't say short run. I would say the market moves significantly a lot day to day. It's very difficult to long. So if you already have China positions, you'll get the rally. But it's, for to jump in the middle requires taking significant volatility. I talked to some salespeople and clients, middle of the week, and in private I did tell them that there is room to run because it's retail driven, and it's not just the government buying. Actually, government most likely is selling their equity to make some profit, because they went into the market a couple months ago to pop up the market, and it didn't quite succeed. The market slide down. But now this pop up is making government's books in positive territory. So they are most likely taking profit. So it's I think overall two things is very clear. One, going short on China is going to be difficult, because then your counterparty will be the People's Bank of China, and it does have a lot of experience in squeezing shorts. From currency market, they have credibility, they're very successful, and I think in the equity market they will also be successful. So unless someone is very willing to take the pain of short being squeezed, then short selling on China will become more difficult. Second thing is that just like zero COVID opening, I think a lot of people are negative on China, partly because of the political system, right? China is authoritarian. But I think in some way, people do underestimate that China's top leadership, including President Xi, is a little bit, I would say, at least when push comes to shove, they do relent. So I think I remember that before, when zero COVID was really, really difficult for the local businesses, and some people were talking, zero COVID will go on forever in China, or like go on 10 or 20 years. But when when there was some local activities, it actually started in Guangzhou first. I know a lot of people are talking about the protests, but actually it was started in Guangzhou by these workers who really is in a tough situation, and then they become rebellious, and that pushes out into the rest of China, and then China just open up, out of like at that time I remember there were so many jokes that there was no fever medicine, because nobody was expecting China to open up. Most people at that time was expecting China to open up after spring, like March. But again, I think the local situation in China, the economy is pretty bad. There are a lot of unemployment rate. The youth unemployment rate was 18.8%. It will go down a little bit because usually during summer it goes up with all the people graduating. But I think it's hard to go under 15%. So the economy is really difficult. A lot of unhappy citizens. It's not kind of serious protesting, but you can see there are, the grumbles, there are, some people who don't have jobs tends to, turn to crime, and China's crime headlines has definitely increased. So I think now there is sign that the government is much more willing to go physical and monetary policy shift. In terms of fundamentals, the fundamental is still similar. It's very difficult for China to go out of this deleveraging, like leverage based, because housing used to be a big part of the people's wealth, and then now housing definitely has, lost 30-40%. The fundamentals, people doesn't want to spend. These kind of things, on average, I don't think it's gonna be completely quickly changed. And the rally in some way will look very a little bit like COVID, and also it's difficult to go against the market right now because of the potential being short squeezed. So I think the rally, we'll see. I mean, U.S. market is open and Hong Kong market will be open on Wednesday. Tuesday will be closed. So I think it really depends on how many retail investors are willing to come in with their own money. So for these kind of things, it's really difficult to catch. For investors, I think overall, slightly longer term investors, is that you want some China exposure. I would say, maybe you don't want the full China exposure, but just completely avoiding China, probably not necessarily the best strategy. So actually in a lot of our, strategies, we still have a little bit of China exposure. Even, for example, some of the battery fund, even though it doesn't have China in it, there are Chinese equity in it. So I think that's probably a good baseline to have. Obviously, if you really don't want any of these kind of very policy driven kind of rallies and then very policy driven kind of downturns of China, you could choose, emerging market, but exclude China, and then add a little bit of China, depends on how you see it. Or you can go completely in, I would say, strategy driven. So if you have a dividend weighted emerging market, then the China weight is, driven by the dividend weighting scheme, not making a huge active play on China. So I think that's probably it's very interesting. China's had these kind of rallies before. 2015 it went up, really, really big, and then came down. And actually the president was not very happy at that time. But how long this rally will go, I think you really have to pay attention to the local sentiment, because the fundamentals doesn't change much. And actually, the fundamental is going to be, China is not collapsing, that's for sure. And we've always said, at least I've said, in the short run, the war risk, with Taiwan, with US is very low. So it's still meant to, it is investable in some way. Now, whether you're investing in China because it's cheap, the earnings ratio, the price to earnings ratio is still very low compared to the other markets, or is it because you just want a trading opportunity, or you're looking for much longer term, kind of betting on something that China's technology, even though it wouldn't be, taking over US, but it can keep up with the US. So depends on how you are thinking of investing in China, or you just want to go, part of the market cap weighted in emerging market. Now, again, that most of the typical emerging market has 20%, 23%, depends on which one index you use, China. So is that a kind of exposure you're comfortable with in your emerging market? So I think all these there are existing strategies you could, depends on what you are comfortable. Actually, WisdomTree offer a slew of strategies from 0% China to full weight of China. So again, from capital markets point of view, it's a very interesting week. China has been so much policy driven things, which is very different from the rest of the world. But on the other hand, if you think about the party, almost like the Fed, US market is very Fed driven as well. Obviously, U.S. market, you also have Congress who have these stimulus money, but a big part is driven Fed. So in some ways, that similarity is still there. It just China is also more opaque, and sometimes there's a 12-hour time zone. Sometimes I get up in the morning, the news, there's so much news to digest. But it's a very interesting. We'll see how this. I think it's there are past analogies of these kind of retail driven rallies. A good trader can do well in this kind of environment. But again, I think it really depends on what kind of risk you're thinking for your portfolio for China, because most people probably less than 5% of China in their portfolio. And I did a quick poll on Twitter and asking people like, why they are investing in China. And of course, making money, but there are many markets like US, you can make money, not just in China. So we asked them, is it valuation? Is it diversification? Is it trading opportunities? Is it a competitive advantage? We are posting this on Spotify as well, and definitely welcome you to put in your opinion. It's interesting that it's a small sample, but still, I think a lot of polls is generally representative of overall sentiment. So about 40% is still thinking China because China is cheap valuation. And then I think 30% is about having trading opportunity. And then the rest, I think 15 to 20% each is about China offers a competitive advantage technology wise, such as battery. So I think really depends on how people are thinking of China and then picking up products that's consistent with their own macro view and the risk taking. Okay, thank you, and we hope to continue to bring more views and contents on China down the road. Thank you.